Well, good morning, everyone. I think everyone's made it in through the welcome portal. So thank you for joining us for this monthly Nikko update. We're going to follow a similar format to do most months. We'll have our guest international speaker for the first half hour, and then we'll turn to more local matters with our domestic speakers between 10:30 and 11 o'clock. If you're new to the call, welcome. We don't have a facility for taking live questions, but if you'd like to either text them through, email them to the team here, I'll be collating those, and if there's time, I'll pose a couple of those to the speakers as may be possible. But without me rabbiting on for any longer, I'll hand over now to our guest speaker this month, who's Andrew Hunt. I think he's known to everybody on this call. We're always really appreciative for his frank insights, comments, thoughts, and gentle humour at what's going on in the world of finance. So Andrew, over to you, and thank you so much for staying up at 11 p.m. UK time to talk to us here today. So in your hands. Thanks, Andrew.
Thanks, George, and good morning, everybody. Just to share the screen as quickly as I can. Actually, that may not have worked. Let's try again. Hopefully we now have the presentation. Just a few introductory comments. This is a fascinating time to be an economist. I almost feel privileged in a way. I think we're seeing some potentially seismic changes within the global financial system. And in particular, a change in the world that we've become used to over the last 30 years. And essentially, the US has been remarkably generous in providing dollar liquidity internally and externally, particularly externally. This supply of dollars to the rest of the world, really from the mid-80s onwards, has created a world of what I would call soft budget constraints, where if you needed to borrow dollars, chances are most years you could. If you wanted that tall building somewhere in Asia, or you wanted to finance a current account deficit, if you wanted to build a palace in Istanbul, all of that was possible in those easy credit conditions. But I think that world may be about to change, and not necessarily because of something the Federal Reserve is likely to do. Now, what we've seen in the last 20 or 30 years is as the world has become addicted to the ability to borrow dollars easily to finance all of these things, often things perhaps they shouldn't be financing. In the rare occasion when they haven't been able to borrow, you generally find there's quite a sharp slowdown in the world. The tide goes out, and that old saying, you find out who's been swimming naked. That's where you tend to see moments of distress. And I think we've got an interesting test coming up in the months ahead. It's certainly very likely that as the dollar credit tide goes out, the US, I think, will remain relatively resilient. But just as we found in the early 80s, and particularly 94 going into 95, it's the rest of the world that has the bigger problem when the US tightens. Because we've created a world of significant moral hazard. What do I mean by that? I mean that since Alan Greenspan's earliest days at the Federal Reserve, there's been an impression that financial markets are insured, that the Fed is underwriting them. We've all read about the Greenspan put and the Fed put and the Fed's desire to see asset prices rising. And that's created an impression amongst, I think, many investors, both professional and in the retail arena, that markets are insured by the Fed. But where you have insurance, you normally have moral hazard. I remember when I was at university, the example of moral hazard that was always given was if you insure your car, you're less likely to lock it. You'll take more risk. And we've certainly seen the financial sector, the professionals, as it were, within the financial sector, taking more and more risk since the mid-80s, running with more leverage, often believing that if something goes wrong, the Fed, they're too big to fail, the Fed will have to save them. That obviously caused problems back in 2007, 2008, but we've been rebuilding that world since. And I think it's significant that if we look at the leverage cycle, the credit cycle within the financial system, so this is banks and other financials lending to other financials so that they can speculate in markets, you can see pretty much all of the booms and busts that have occurred within the global system. But it's not just professionals that have learned to take more risk in this environment. If we look at the household sectors weighting towards equities within their balance sheets, since that Fed put, the Greenspan put, was first mentioned back in the late 80s, people have run with more risk. So I think there's a general assumption or a hypothesis that you take more risk, you speculate, you take part in the risk markets, safe in the knowledge that the central banks, particularly the Federal Reserve, sort of have your back. And arguably, it's always going to take a very large shock for those central banks to step away. And nobody's expecting one of those, so it seems that you have carte blanche to continue to lever up, to continue to invest. And we have a fairly simple story for this year and next year. There's I think, a general assumption that China's economy is already well on the way to recovery, that the US will soon recover. Belatedly, Europe will join in once the third wave of the pandemic eases. And we'll have a period of synchronized global growth. And the textbooks say in that environment, you gently sell bonds, you perhaps buy the US dollar and commodity currencies, and you rotate into cyclicals within the equity market. And that pretty much is the story of the opening few months of this year. And it's an environment that we've seen before. 1994, there was a synchronized global recovery. Bonds were weak, the dollar was stronger, and it certainly paid to rotate into cyclicals. But what a lot of people forget about that 94 precedent is, oddly enough, it was followed by 1995. And 95 was actually a pretty poor year. We'd seen a lot of weakness in emerging markets, both in their equity markets and in their growth. We had the Mexican crisis, a similar economic crisis in Brazil. Some of Europe was quite weak. In fact, Europe only escaped a recession by a sort of hair's breadth. The one economy that was reasonably strong in 95 was the US. And as I mentioned earlier, when US monetary conditions tighten, yes, the US slows down, but often it's the rest of the world that suffers the most. And I think as we look into 2022, we might have to think about that scenario again. Because if we are seeing a period of synchronized growth, then it is likely that credit conditions, monetary conditions in the US are going to be obliged to tighten, even if the Fed doesn't want that to be the case, and that will affect the global growth outlook. Now, of course, we've all seen the chairman of the Federal Reserve say that he doesn't intend to tighten, that he wants to run the economy hot, that he wants to generate full employment and hopefully provide some help to the weakest members of society, or the poorest members of society, the most disadvantaged. And he, I think, genuinely does intend that to be the case. But if you listen to the Q&A sessions in the recent Federal Reserve meetings, he's beginning to give himself that sort of economist get out of jail card that if the facts change, he will change his opinion, particularly with regard to inflation. Now, I think a lot of people are quite sanguine about the outlook for inflation, saying we saw a big policy response in 2008, 2009 to the global financial crisis. The Fed and other central banks printed a lot of money, and that didn't cause inflation, so why would it this time? Well, I'd suggest that at the moment we're in a very, very different world to the one that existed back in 2009. Yes, we've seen the same large fiscal transfers. The public sector deficit has widened. We've given money, we've transferred money to the private sector, just as we did back in 2008, 2009. But crucially, what has the private sector done with this money that they've been given? Back in 2009, they used it to repay debt. Households delevered, corporations delevered, and certainly the financial system used a lot of the money that was given to it through those fiscal transfers to delever. I mean, I remember, actually, I think it was about 2010, spring of 2010, an old friend of mine who'd been promoted to quite a high level at one of the big US investment banks. He said, let's meet for a drink. Let's not meet in the office. So we met somewhere near Central Park. He said, I need a drink. I have just written off $156 billion of this bank's mortgage exposure. So as you can imagine, he needed that drink. And that destroyed an awful lot of liquidity in the system. So much of the money that was given to the US private sector after the global financial crisis went to fund debt repayment, which you need cash to repay debt, and when you repay that debt, the debt is cancelled, but so is the cash. That's not what's happening at the moment. We've got these big fiscal transfers being given to a US private sector that, if anything, is re-leveraging or has been re-leveraging, particularly within the financial sector itself. So we're not destroying money by repaying debt. We're taking that money, or the US private sector is taking the money that's being given to it by the government and adding it to its usual money creation. And that's a very different dynamic. Something else that's very different is even despite those big transfers last year, we're giving, or the US government is giving people even more money. And it's not just the stimulus checks that we read about that are the stimulus here. It's the way in which the government is funding those checks. They're not issuing bonds to fund those checks. It's not a case of, here's a stimulus check, here's some money to Joe Public, but we're going to issue bonds which suck money back out of the financial system. On this occasion, the government has funded the budget deficit by either selling bonds to the Federal Reserve, quantitative easing, printing of money as people like to call it, or the government has been running down its own cash reserves. The US government started this year with $1.6 trillion of cash on its own balance sheet, and it's raided that piggy bank to fund these stimulus checks, and that has the effect of QE. So in the last 6 weeks alone, we've seen a $1.5 trillion increase, nearly 5% increase in the US money supply in 1 month. That's unprecedented. Even the Wall Street Journal has jumped on this. This is a cartoon I stole from them. So it's not just all the stimulus last year, which had a very different dynamic to 2009. We've added even more fuel to that fire. So the household sector has seen its cash balances rise by almost 30% in the last 14 or 15 months. And you've seen their balance sheets inflate on a proportional basis. The value of the equities that they own is up almost by 30%. The value of the properties they own is up by 28%. And increasingly, they're increasing their expenditure and real goods and services by the same amount. So you've got this proportional inflation of the balance sheets. And of course, there's no way the supply side of the US economy can keep up with this. And that by itself suggests there's a potential for inflation there. We're also in a very different situation with regard to global trade prices. Back in 2009, we had acute world trade price deflation. In particular, Asia was charging less for the products that it was selling to the rest of the world. They needed to clear inventories. This year, they're charging more. Import prices are rising in the US, not falling. Korean export prices are rising at their fastest pace since the 1970s. And traditionally, I've found that if Korean export prices are rising by more than 5 or 6% a year, you worry about inflation globally. They're up 15% in the last 12 months. So we haven't got that fall in import prices to offset domestic inflation in the US. And I think that's an absolutely crucial difference that can add 100 basis points to the US inflation rate, just arithmetically. That's not base effects. This is genuine import price inflation, which will add to the PCE deflator. It will add to the consumer price index. And we have, I think, an overheated economy. There's a lot of debate as to whether the US has spare capacity or not. Certainly we know the COVID shock was a demand shock. People couldn't go out and spend money. But we also know there's a supply shock. Now in economics, you don't get that many large supply shocks. The last one of note was 1973 in the oil embargo. Where you simply couldn't get energy to keep the supply side of your economy open. The global financial crisis was a demand shock. It reduced demand, but it didn't really impact the supply side. We didn't lose many companies. The global economy could still produce as much as it could prior to the crisis. But the pandemic is different. It's reduced supply. And if we look at our estimate of demand pressure, of the output gap, we find it's very positive at the moment, which of course explains why US profitability is so high. Companies are being able to charge more for what they produce. They need to charge more because they're facing capacity constraints. And that is very different to 2009. We had a massive negative output gap after the global financial crisis. Now we have a positive one. And I think that leads us towards inflation. Now, until last night, the Federal Reserve sort of hoped that inflation wouldn't pick up rested on the assumption that there isn't a Phillips curve. Now, the Phillips curve was invented by a Kiwi economist, Arthur Phillips, who spotted there was a trade-off between the rate of unemployment and wage inflation. Now, in many of his speeches in the last 6 months, Chairman Powell has denied there is any relationship. But if we look at the relationship between wages and the unemployment rate in the US from 2016 to 2019, that looks like a Phillips curve that Mr. Phillips would have been proud of. Now, it's only there for those few years and at the early part of the decade. It's not there in every year. And why is that? I think that the Phillips curve in the US, this trade-off between unemployment and inflation, only exists when all of the states in the United States are moving in the same direction. In the early 2010s, growth in the US was really only occurring in 6 states. There were 30-odd states that were actually quite weak. And you had a lot of labor mobility. States that were weak, like Connecticut, lost a lot of their population. Areas that were strong, such as Seattle. I mean, Seattle's population doubled in the early 2010s. And that held down wages in the hot areas. It also meant you tended to have deflation in the weak areas. So you didn't get a relationship between unemployment, growth, and inflation. But when you had coordinated growth, as we did at the end of the last decade, then the Phillips curve tends to reappear. And I can't think of anything that will synchronize global growth more efficiently than these big stimulus checks and the end of lockdowns. So I think there will be a Phillips curve. And actually, I think it was very significant last night in the Q&A session that Chairman Powell actually mentioned the Phillips curve might exist after all. So that's another reason to expect inflation. But I think the biggest reason, just moving quickly through this, is what are companies saying? If we look at the survey data, what are consumers experiencing? The University of Michigan does a good survey on that. The ISM indices, they have price components. Small company surveys, they're all pointing in the same direction. And they're all suggesting that we're heading for about a 4% rate of consumer price inflation. So certainly in something known as the personal consumption expenditure deflator. It was easier when you could just say inflation. And while that's not a threat in the next month or two, I think as we get into the second half of the year, the recovery in the economy will give us wage inflation. In fact, we are seeing some signs of that in sectors that haven't seen big job losses and big job gains because of COVID, if you keep the samples stable. And I think inflation will pick up. Now, of course, a lot of people say that won't affect markets and that Chairman Powell and the Federal Reserve is going to ignore that. And that may be true, but that doesn't mean to say that the monetary system will be able to ignore that. After the global financial crisis, the nature of banking changed. We went away from unsecured deposits, unsecured lending as the main conduits of funds between financial institutions to repurchase agreements. I stole that quote from the head of markets at the Bank of England. And essentially it tells you that if you're going to lend to another financial, you want some form of collateral. And the only collateral that banks will accept are treasury bonds, JGBs, Japanese government bonds, German bonds, and maybe gilts. Definitely maybe on the gilts. Good luck trying to find bonds because the European Central Bank owns them all, and there aren't many JGBs in circulation either. So essentially it's US treasuries. That is, I think, absolutely vital, that the whole financial system is collateralized and it's much more regulated than it was in the past. So that gives us 4 potential constraints on the financial system. Yes, it matters what policy is and whether the Federal Reserve is providing what's known as the monetary base, liquidity, settlement cash into the banking system. We have plenty of that, particularly as the government has run down its own cash balances and released cash into the economy. In fact, most of the US banks are swimming in deposits at the moment. So there is plenty of monetary base, and that's not going to be a constraint on the banks. But the banks also face leverage ratios. And there's a problem in that they don't necessarily have enough liquid assets to match all the liquid liabilities that they're gaining because of this rapid growth in their deposit base. So that's a problem for the banks that worries them. The banks also face a capital asset ratio limitation, and that's where they're getting really stuck at the moment. In fact, you may have seen in the press that 2 of the biggest banks in the US who only 12 months ago seemed overcapitalized, had to do almost an emergency debt issuance last week because they've become short of capital and were in danger of being in breach of the regulations. Their balance sheets are growing so fast because the Fed is pouring so much money into the system that they can't raise capital fast enough, particularly in a world where interest rates are low and people don't really want to buy shares in banks, and the banks can't generate profit growth. So that's becoming a constraint on the banks, particularly in those banks that don't want to grow anyway. If you ask a US bank, what is your nightmare? The answer will be to become a Japanese bank, large and unprofitable. The US banks want to be smaller and they want to be profitable, but that's very hard in this environment. And they certainly don't want to be subscribing new capital. In fact, they'd rather be taking capital out of the business. They'd rather be doing equity buybacks so that they can get richer, or at least the management could get richer. So that's becoming a constraint. But the biggest one is this collateral issue. The bank's risk and compliance departments, who are the people that protected them from the global financial crisis, are saying, you know, we've been lending money to people who haven't been terribly sensible. They've done some wacky stuff with this. We're not really sure how to value some of it. So if we're going to lend to them, we want more collateral. We already want collateral because this is the post-GFC world, but actually we'd like a bit more. And what matters most, therefore, to the financial system is whether that collateral is available, whether there are treasury bonds out there that can be used for collateral. And here we have, I think, the kind of irony of quantitative easing. The Federal Reserve has committed itself to taking out $100 billion of treasuries and other agency bonds a month, give or take 20 billion. So that's constantly shrinking the supply of bonds that's available to the markets. Yes, there's some issuance from the government, but the Fed is buying more. There is issuance at the moment. So you're creating a tendency for the volume of collateral to shrink. Now, last year, that didn't matter. We had a 15-20% rise in bond prices, so the value of the collateral in the system went up. The financial system, therefore, had plenty of collateral. It could continue borrowing, and you could get those leverage flows that I mentioned right at the beginning of the presentation. But this year, the Federal Reserve has taken about $150 billion of supply out of the collateral markets, and bond prices are down. So it looks like we've had close to a 10% fall in the stock of eligible collateral out there. And that's making itself felt in this contraction in lending by financials to other financials. There's still plenty of money in the system. The government is printing so much money that the retail investors are awash with cash, and they're putting that money into GameStop and everything else that they've been doing. But at the professional end of the market, we're seeing an enforced deleveraging, that the financial community is being obliged to repay some of the leverage that it's amassed over the last 20 or 30 years. Now, what does that mean for equities? It means if this process continues and the government ever stops its stimulus, then liquidity will dry up very quickly and equities will be vulnerable. But if the government continues to print money, maybe equity prices can continue for a bit longer, but it will of course become much, much harder for the government to keep giving stimulus to an economy that's clearly overheating, that's generating inflation. Now we know that the credit tide is changing. We can see it at the edges of the system. When the credit tide goes out, it always changes at the edges of the system first, just like a maritime tide. It's always the estuaries that dry out before the center, before the beaches. And we can see, having booming last year, cross-border credit flows are weakening. The European banks are retreating. They used to borrow a lot of dollars to lend to emerging markets. It was their only profitable part of their business. They're running away from that now. The same is true of Japan. In fact, in the 20-odd global banking systems that I've looked at in the last few weeks, the only one I could find that was expanding was the Swiss one. Which would explain why they've ended up holding a lot of the bad debt associated with bankrupt hedge funds and Greensill and other things that we've seen in the newspapers. But I think the global credit tide is ebbing. At the moment, for the main markets, that's being obscured by these stimulus checks and the liquidity implications. But as those stimulus checks start to run off, as the government becomes less expansionary, I think we will see in the second half particularly if bond prices continue to sell off with inflation rising, which I think they will, that the credit tide, the liquidity tide will ebb, and that'll make it harder for risk assets to perform. Now, I'm not too worried about US growth in that environment. US corporates are the most liquid they've been for 2 or 3 generations. The US household sector is in pretty rude financial health. But for the emerging markets, this loss of dollar liquidity that they've become used to over the last 30 years, I think is quite dangerous. And I'm certainly expecting full-blown economic crises in places like Turkey and Brazil. The domestic policy settings have been rather awry for a year or so. They've been dependent on on being able to borrow cheaply from abroad, and I think that tide is ebbing. So I'm expecting the emerging markets to underperform just because of the news event there. Also for their currencies to be weak as they struggle to raise credit. Even China, I think, will see some degree of a slowdown. Now, when it comes to North Asia, this might represent something of a buying opportunity. I think we are seeing Asian companies discovering the concept of shareholder value, becoming less dependent on borrowing on a trend basis, and more likely to focus on the cash flow and their profitability. So if we do see some weakness in the Asian markets in the next year, that perhaps represents a buying opportunity for stock pickers. But in the near term, I think this sort of aggregate, or this macro trend of the tide going out will dominate what happens to share prices there. In China, we have an inflation problem. Now, to be honest, the Chinese Consumer Price Index actually is a measure of pork prices, and I'm not about to sit here and try and forecast the direction of pig prices in China. But away from the rather politicized Consumer Price Index, clearly inflation is rising. I think inflation in China is already over 3%, and it's probably heading for 5 or 6%. That can be awkward for the regime. And at the same time, we are, I think, drifting into a new Cold War. In that Cold War environment, China will want to maintain a large current account surplus. How will it do that? By restricting import growth, by trying to contain domestic demand growth. And that's why the Chinese authorities are tightening. Now, they haven't got control of their economy yet. It'll probably take them a few more months. But I think as we get towards the end of the year, we will start to see China, along with the other emerging markets, slow down. And that means that global growth in 2022 is likely to be weaker than markets are expecting at the moment. Again, shades of 1995 there.
Andrew, just a 2-minute warning in the wrap up, just in case you're looking at the clock.
Yeah, very, very quickly, what does that mean for New Zealand? I mean, I think it would be fair to say New Zealand could do with a productivity lift. It could do with some supply side reforms and perhaps some change in economic structure. But in the near term, the outlook, I think, for New Zealand's growth, and particularly for the currency, is really dependent on 3 things. The terms of trade, which, as you can see in the top panel there, is largely a function of Chinese growth. That's likely to peak in the next couple of months. Population growth, obviously difficult during the COVID pandemic, and then changes in global funding conditions, which, as I've mentioned, I think will become harder. So I am looking for the Kiwi dollar to peak in a few months' time, and it probably doesn't get any better in terms of New Zealand's rate of economic growth. Elsewhere, Japan really quite quiet. I think that's a stock picker's market. Europe, I'm not looking for much of an economic recovery. They haven't had any income growth now for 18 months. And actually, the German economy is becoming quite uncompetitive. There's a real shift in the center of growth, the center of gravity of growth in Europe, from Germany, Holland, and the northwest part of the continent to the south. Italy may turn out to be one of the better performing economies over the next 5 years. Now, typically, when the German economy underperforms the rest of Europe, the euro is weak, and I think that will be the case on a trend basis. Finally, the UK. In theory, the UK could prosper. Large negative output gap and probably the most competitive economy at these exchange rates in Europe. It just needs a little political will and a little political bravery. So if we can drag ourselves away from worrying about Boris Johnson's redecorating of his flat and actually focus on the economy, the UK has the potential to have 4 or 5 years of rapid non-inflationary growth, given where the economy is now. Unfortunately, I have a feeling that at the number of political distractions around at the moment, we might yet manage to snatch defeat from the jaws of victory. But conclusions, Essentially, I think the global credit tide will go out in the second half of the year. The Fed may not want that to happen, but in a sense, they've broken the banking system, the regulatory environment, the enforced inflation of the bank's balance sheets by these various stimulus measures. All of that has conspired to make the US banking system fundamentally weak. And once we lose the monetary impulse from the current round of stimulus, I think we're going to face a very different and perhaps more difficult global liquidity environment, which poses a risk, first of all, to bonds. With that rising inflationary environment and the liquidity tide going out, that tends to be negative for bonds. But ultimately, I think it'll be negative for equities. We could see some volatility there. But the other side of that volatility, of course, will be a weaker global economy in 2022, which leads me to think there might well be a buying opportunity for bonds at the end of this year or early next year, as people come to realize that actually the global growth is not just going to extrapolate to infinity and beyond, that next year could actually be quite soft in comparison to what markets are anticipating. So I think it's a year to be quite active. Watch the end of the stimulus effects. I think that could be quite destabilizing for markets, but there will probably come a time to buy bonds and then rotate back into growth and back into those bond proxy type equities for another round in this sort of global liquidity ebbs and flows cycle as we go through the rest of the decade. So that is a quick version of the presentation.
Andrew, thank you. Look, that's insightful and interesting as always, and we do appreciate you spending your evening chatting with us and taking us through those thoughts. And as you say, it was a quick run through, and there's certainly many themes in there that would be worthy of further detailed exploration. So, but we do need to move on. So thank you for your time, and we'll look forward to catching up with you again in due course. And we take care and wish you well as you ease your way out of lockdown.
Yeah, we hope.
Right. Well, we're going to turn a little bit closer to home now, looking at the New Zealand debt and equity markets. And I'd like to introduce you all to Matt Johnson, who is probably known to some of you, but probably not everybody on this call. Matt has been with us for about 2.5 years now, but actually that doesn't tell the whole story. Matt was an equity analyst with us a number of years ago. He did the Kiwi OE thing and came back to the fold, as I say, about 2.5 years ago, where he joined Ferguson Ian in the fixed income team. And Matt's been a fantastic addition to the team in supporting and helping us tighten up and improve some of the ways that we think about credit and our analysis of credit. And he's frequently involved in trading of the portfolios and repositioning the cash and the bond books in the market. So he's well experienced, very knowledgeable, and I'm delighted that he's going to speak to us now for the next 10 or 15 minutes on what he's seeing in the New Zealand debt market. So over to you, Matt.
Great, thanks, George, and hello to everyone on the line. As mentioned, my name's Matt, and I'm part of the fixed income team here at Nikko. For today's talk, I thought I'd go over some of the key themes the team is thinking about, what we think is important and what is perhaps less important. If I just move on to the first slide here. Flick onto the next one, please. So I thought I'd start with this time last year, and perhaps unsurprisingly, the most important theme then was the increasing escalation of the COVID crisis. You can see the first vertical grid line there in the chart is the start of April. The WHO had just declared COVID a pandemic. Various lockdown measures were being put into place around the globe, and we had complete market dysfunction. The general thoughts were unemployment was going to rise, production fall, demand disappear, and companies collapse. However, that did not occur. Businesses turned out to be adaptable, as did society, and much more resilient than expected. There was a drag on growth, but the mass failure and increase in unemployment did not occur. And one of the reasons this didn't happen is the significant support from governments around the world, which I'll touch on a little bit later. Today, these waves are still making their way around the world, but from a market's perspective, perhaps they are of less importance as markets tend to be forward-looking, we are looking to the rollout of various COVID vaccination programs around the world, which is on the next slide. So here you can see the current rollout of vaccination programs around the world. And this is probably one of the most important themes of 2021, the rapidity of the rollout of vaccine programs in major economies around the world. If you look at the chart there, you'll see the number of people as a percentage of the total population who have received at least one COVID vaccine or more than one COVID vaccine. We've extrapolated that out at the current rate of dosage over the last month. And from that, you can see in the US, we may be at herd immunity, 75% of the population vaccinated by the end of June, perhaps July. And I note overnight, New York's mayor was targeting 1 July as an economy opening update. So that sort of ties in with those very simple extrapolation numbers there. These are in no way sort of medical forecasts. They are just an extrapolation of the current vaccination rates. Europe, you'll see it's looking like perhaps Q3, August, September, we might see vaccination programs reaching 75% there. While in New Zealand, despite the government having a target to be complete by year end, they will have to significantly increase their vaccination rate to get there. So that's a little bit of a concern. We will have to see some improvement there for us to catch up to these major global economies. If we move on to the next slide here. In this slide, the key thing I want to point out here is the level of government support around the globe. You can see New Zealand up there as the number 2 most supported economy as a percentage of GDP. I think it's not, you shouldn't focus too much on the absolute numbers, but more the level of support being consistently strong across the globe. And this is very different from last time we had a global downturn, the global financial crisis in 2008 and 2009, where austerity was a key strategy from a government perspective. You had to get your spending down and let things delever. That is not the approach being used currently. And that's really supportive of economic growth. We saw that in New Zealand as we moved out of lockdown in Q3 with economic growth up 14% there, with pent-up demand and all the government stimulus contributing strongly to consumption. And there's really no reason why we shouldn't see something similar in other major economies around the world. They are still in various forms of lockdown, but as they emerge, we could see upticks there. And this strong growth could lead to inflation. We've seen some concern around that in the bond market, particularly the longer end, earlier in this year, with yields on 10-year securities moving up significantly. They've since abated a little bit. However, the theme of inflation being a concern is still out there. Looking at our domestic economy, possibly New Zealand's already had its recovery in Q3. Fourth quarter economic growth was actually a decline of 1%, with the downturn most strongly seen in the construction sector, which was down 8%. That's a clear sign of capacity constraints in New Zealand's economy. And New Zealand has historically relied on population growth to achieve economic growth. With the border closed, we've lost one avenue to support our economy. It will reopen at some point fully. However, when it does, New Zealand will be competing against all these other countries for a pool of talent. And if they are seeing strong economic growth, New Zealand's not guaranteed to get the resources it needs, which I'll touch on shortly. If we move on to the next slide, please. So looking at New Zealand's domestic inflation situation. This is the most recent numbers, and you'll see 1.5% inflation growth. There's really no sign of supply constraints driving inflation yet. This is somewhat surprising when you think about all the stories in the media we've heard about the supply chains being broken, retailers not being able to get the goods they need, the building sector not being able to get timber, labor being restricted. So there's a lot of things out there in the system that you would think should support a supply constraint driven inflation blip, but it's just not coming through. In fact, the only real positive in the March quarter inflation numbers was the uptick in oil prices, which drove transport up 1.7% there. This does not mean that we're negative inflation, but more we haven't seen this widely expected uptick in inflation yet. One of the things we can do as a bond manager to manage inflation, which is probably the worst enemy of a bondholder, is hold a position in inflation-linked bonds, which we do in our portfolios. You'll see I've got a chart up there on the right showing the break-evens on inflation-linked bonds in New Zealand. And these probably are a proxy for inflation expectations domestically. Inflation-linked bonds are held by domestic institutions, but also offshore institutions. So it reflects a range of views. And you can see there the break-evens have moved up. They're around 1.75 to perhaps 1.5 on the low side as a break-even. The Reserve Bank's target is 2%. They haven't achieved that for a while, but at 1.75, you certainly say they're quite fully valued. Should we see a uptick in inflation, that might be an opportunity to reduce positions in inflation linkers. Inflation is widely viewed as a temporary advent of the various lockdowns around the world. Central banks, including the Fed and our own bank, have said they expect an inflation uptick, but they're not really concerned about it. They think it'll be transitory, which is understandable. Once supply chains free up, the movement of people occurs again. There's no reason why things can't return to where they were prior to COVID. We still have aging populations around the world, which is generally a downward driver on inflation. And we have disruption from technological development, keeping a lid on wage prices and so on. So we're looking for a short-term uptick here in New Zealand. We don't think the Reserve Bank will react to that. They'll see it as transitory, but it is something you should keep an eye on in your portfolios. And moving on to the next slide, as mentioned previously, New Zealand has historically relied on population growth as a form of economic growth. You can see the series up there. If you look at the top chart and the light blue bars there, those are our net migration numbers. And over the past 5 years, prior to the COVID crisis, we've had extremely strong population growth. That's really driven a lot of economic performance in New Zealand. The question is, what will happen once the borders open up? Do we get migrants returning? Are we going to bring in the right types of migrants to fill the shortage of skills we have? Will we have people departing if other economies are performing strongly? So I think we should keep an eye on migration. It could be a very strong driver of economic growth, or it could be a headwind to growth going forward. If you took it away, another key feature of most developed economies around the world, and certainly New Zealand, is birth rates have been declining. And in fact, New Zealand's birth rate is currently 1.61 births per woman, which is well below the replacement rate of 2.1, and at one of the lowest levels seen in all the data recorded. During the crisis of 2009, we actually had an uptick in birth rates. That's probably not going to occur given we were all locked down in our own homes. So we really are relying on migrants coming in to get our population growing and support economic growth. So we should really keep an eye on what's happening there as we move forward into 21 and 22. Looking at the next slide. So looking a little bit more micro here at the domestic bond market. A key feature this year is the significant volume of high grade maturities in the corporate space to occur this year. Notably in the second quarter, the current quarter, there are $4.8 billion of maturities occurring. There's been some concern that we won't see new supply to replace these. We've got banks who have funding available through the Reserve Bank and are very well funded. They might not return to the market. We've got corporates who are reluctant to spend despite capital being as cheap as it's ever been. So they might be a little bit hesitant to come to the market there. At the same time, inflows continue to hit the market. We've got KiwiSaver, which just is a wall of money that continues to grow. We've got asset allocation positions, which we haven't seen moving away from fixed income or cash. There might be some movement at the margin, but in a balanced portfolio, fixed income makes up a large proportion of your asset allocation, and that's unlikely to change in aggregate. So all this money is coming in. We've got maturities. What that means is any new issuance is highly sought after. This month, we've seen a number of new issuances come to the market. They've all been really well supported. I'll go through a list of the key ones here. So Dunedin City Treasury issued at plus 50 to mid-swap, about 20 back from LGFA. That looked like good value, and we participated there. As a guide for demand, scaling was about 55%, so really well supported. We've also had Housing New Zealand issue. They're going to be a regular participant in the market through the year. Again, a very small new issuance concession there. Was about one back from the existing curve, and really well supported there. About 55% of the book was taken by balance sheets, and our allocation, we received about 60% of what we bid for. Again, a sign of strong demand. And this week, we've had ASB issue. They printed 500 million at plus 60 to mid-swap. So a reasonable size ticket there, and we got reasonably well filled on that one. And the World Bank came in and printed $1 billion. That's a very impressive print, which actually had really strong support from balance sheets, who took about 79% of that issuance. And a reason perhaps those balance sheets are there is this lack of issuance. Historically, balance sheets like to hold assets out to about 5 years. This was a 7-year issue, and balance sheets were there for the lion's share of it. So a key feature that will carry on this year is, will we see issuance in the market? We think issuance will be limited, and that'll support credit spreads, keeping them tight. Finally, moving on to the last slide here. Another key theme for the year is the slope of the yield curve. With yields backing up on concern around inflation throughout the globe, the credit curve has become very steep. In the top chart, you'll see the slope between the 2 and 5 year points of the swap curve. And you can see it's as steep as it's been since 2017 or 18. Now, a steep yield curve is really helpful to a bond manager. It's really positive for roll and carry investment strategies, buying out long, letting your positions roll down the curve for a few years, and then exiting and resetting out longer again. You can see the same thing in the chart at the bottom, the 10-year, the spread between the 2 and 10-year points in the curve is steeper than it's been any time in the past 5 years. And the reason it's steep is the front end of the curve is really influenced by domestic economic conditions and the Reserve Bank's policy position. The Reserve Bank has been adamant for some time that stimulus will be needed for an extended period of time. We have no reason to try and doubt their position. We think they'll follow through and keep stimulus running for longer, perhaps than necessary. We've seen similar comments out of the Fed. In fact, this week, Powell was out in the market saying it's far too soon to even talk about tapering there. Again, they're very happy with letting markets run. And should inflation come back, in general, central banks are confident they have the toolkit to be able to shut down inflation. It's a lot easier to slow inflation than create inflation with the various macro features of the market. So we think the front end of the curve will remain low, with the Reserve Bank not cutting this year and perhaps not in the following year, while the longer end is going to be driven off global growth and concerns around inflation. And that'll keep the credit curve nice and steep, which will support holding positions in that mid-curve part of the credit curve from 5 years out to 8 years, perhaps. So those are the key themes I have in this presentation. Just as a conclusion, perhaps highlighting the key themes here. One, we think the yield curve is steep and will remain steep, as shown on the slide. That's going to be positive for bond investors. Credit spreads, they're going to remain tight through the year due to the lack of issuance and strong inflows from KiwiSaver. Inflation, that's a risk. No one really knows where it's going to go. There's a lot of items out there that point to potential inflation pressures in New Zealand and offshore. The bond market will react to that, and you'll probably see that in the longer end of the curve, looking 10 years out. NZ, our economy's perhaps seen its recovery already, which is unfortunate. We really need to see the right skills brought into New Zealand through population growth and migration. So that's a key thing to keep an eye on when you're thinking about New Zealand's economic performance. And finally, central banks, highly likely to remain in their in easing stances. They'll let economic growth run and ensure it's really strongly there before taking any steps to slow the economy, which will likely be done through a tapering of their various quantitative easing programs before moving any cash rate positions upwards. Great, thanks everyone, and thank you, George.
Thanks, Matt. Appreciate that. And we'll flick now to the domestic equity side with Stu Williams, who's going to join us. So firstly, my apologies to Stu and those of you on the call. I've not done a great job yet again of managing the timeframes on this. So what I might suggest, I'm conscious that we've got a 10 to 11 slot, but what we'll probably do is, I know Stu's got some interesting material prepared for us. If you need to leave at 11, absolutely, we understand that. But Stu, maybe rather than trying to fit your presentation into the 4 remaining minutes, we just allow things to go past 11 o'clock and hear the fullness of what you've prepared for us. You're currently on mute in that room, so I'll let you unmute yourself, and we'll put ourselves in your hands. Thanks, Stu.
There you go. Hopefully you can hear me now.
We can indeed. Thanks, Stu.
Awesome. Yeah, I probably will just really compress what I was going to talk about and try and keep it to a couple of key points. Sort of to jump into the middle of what I was going to talk about is really just to talk about the earnings season that is starting next week. So it starts next week with Z Energy and it finishes at the end of May with Fisher & Paykel Healthcare. So this is for the March reporters. So just in terms of expectations for the year ahead, revenue growth in aggregate for the market is expected to be about 5%, which is decent. And with some operating leverage, that translates into earnings growth of about 14% for the year ahead. And that's a pretty marked improvement over the same readings at December. So that's aggregate EPS earnings expectations for the market. And then taking a slightly longer read, expecting earnings growth in aggregate for the market to be about 8% over each of the next 3 years. So just briefly on key stocks. So Z Energy opens the reporting. What are we hoping for? What are we expecting? First of all, hopefully they don't stuff anything up. That they have recently reiterated their guidance, which is positive. They are talking about paying a dividend of 12 to 14 cents. They may give guidance on 2022, but it would be pretty wide if they did. And we'd expect some information about their negotiations with NZR in terms of NZR's transition to be an import terminal, which in aggregate is positive for Z, given it will release some working capital. So other companies reporting in the next week, we've got Mainfreight, which is overweight, next month, not week, Ryman, which is underweight, Infratil, which I'll talk a little bit about in a second, which is overweight, and Fisher & Paykel Healthcare, where we're modestly overweight, and it's in the concentrated fund. Then we move into the more outlook stuff with investor reports, investor days for Meridian, for Contact, importantly for Fletcher Building and for Sky TV. So just briefly on Infratil, because it's on my mind, I'm the analyst and they had quite a big announcement yesterday. So Infratil is about 1.5 to 2% overweight across the funds. It's about 11% of the concentrated fund. And there's been a massive volume of information to digest over the last 3, 4, 5 months. So of course we started off with the unrecommended, unsolicited, incomplete offer from AusSuper for about $7.43. Stocks trading about $7 for reference today. Then we also had the acquisition of QScan, diagnostic imaging in Australia. And recently we've had the updated and recommended offer for Tilt. So that's very positive. And then yesterday we had a new acquisition for Pacific Radiology announced, about $350 million spent for 50 to 60% of the business. So that fits nicely into that diagnostics medical vertical that Infratil has been talking about. So yeah, we're really positive about Infratil. We like all of the exposures that they have overall, with the possible exception of their RV, retirement village exposure in Australia. See valuation in excess of $8 versus around $7 just now. One of the more fascinating results to come will be Fisher & Paykel Healthcare. They'll be talking about earnings growth that's more than 100% up 2021 on 2020, and whether they can give guidance given the uncertainties of COVID will be really interesting. I won't talk a lot about a couple of the other things that I'd contemplated. I'll just remind you about key positions in the portfolio and just comment on a couple of changes or tweaks in the portfolio before seeing if there's any questions. So the key names that we like in the portfolio have remained relatively consistent. So, Spark, Infratil, EBOS, Somerset, Ingenia, FPH, of course, Contact. We are underweight in the core fund and have a very small position in the concentrated fund in A2 Milk, which is obviously very topical. And new positions established in the funds over the year to date include Sydney Airport, which is more palatable, on a valuation sense, and a hedge against the reopening trades in Auckland Airport, as well as ANZ Bank. And then my final point is just to talk a little bit about ETFs and how that all turned out with the trades that occurred in Contact and Meridian. You'll recall that Contact was a very large overweight for us. I think back in mid last year, around 3.5% overweight. Into the ETF trade, we got it pretty much back to a nil active position, and substantially reduced it in the concentrated fund. The ETF trading on the actual day was quite counterintuitive, with many tens of millions of shares to be sold. The price actually went up. What we've done over the last 2.5, 3 weeks is to, I'll call it snipe stock when it's on days that it's been weak, because it's been intraday quite volatile. So we've been accumulating both Contact and Meridian. Our preference is for Contact still on a valuation basis. So that's been a positive contributor on a full year basis, that trading, which is good. Quite tricky to manage it given the volatility and the steep fall post or at the very start of this year. I'll just stop there, mindful of everyone's time. That's as abbreviated as I can go. If there are any questions, I've got time, but if you've got something else to do, then I'm fine with that as well, George.
Thanks, Stu. Look, we haven't had any questions come through online through the Q&A. Maybe one area, if you could just touch on briefly, the stock that's been quite interesting for us in our portfolios is something like Z Energy, which has had a bit of a tough time of things. With their dividend expecting to return, what's your thoughts and outlooks for how that stock might progress?
Yeah, we're still positive on Z. I mean, our whole process is built on the idea of consistently thinking about valuation gaps, and occasionally you get wrong-footed by things. But the valuation gap for Z is enormous, and the things that can wrong-foot them going forward are much diminished. And so we think about the valuation gap, and we think about near-term and medium-term catalysts. So dividend is a catalyst, settlement of how they'll interact with NZR is a catalyst and releases working capital. And as we've said many times before, the appetite for fossil fuels is enormous in New Zealand, in the New Zealand vehicle fleet. And I was just reading some research this morning talking about the plateau of the purchase of EVs that everyone's quite focused on in New Zealand. So EV purchases into New Zealand are coming, but they've plateaued at about 500 vehicles per month for the last couple of years. So we see the best catalysts are ones that you can't ignore, and dividends in the world that we live in right now are an incredibly strong catalyst.
And we'd have just had a query come through on A2 and Synlait. So a few thoughts on those stocks, please.
Yeah, so A2, so if we went back middle of last year, it was about 13% of the index. It's now about 4.5% of the index. We've done a good job of managing down that exposure. We are concerned that the company has persistent. This is A2. The company has persistently been a tad too aggressive in terms of the guidance in the COVID period, and so we're concerned about that right now. Hence, we're underweight, and we would rather re-engage with it on an upward trajectory. The reason we don't have none of it is that the medium-term value is enormous in this name. It's just the news flow is unhelpful just at this point in time. The Synlait part of it, obviously they're a large holder in Synlait. Regulation, re-registration is something that we're thinking about there. We've got every reason to expect that they'll be successful in that. And at the end of the day, milk powder needs to be consumed in China. We don't have any real concerns about the brand validity, and so the value that is evident to us above the current share price is quite large, but we would rather re-engage as the stock makes a positive move, as opposed to while it's dealing with the potential for perhaps one more earnings adjustment to be made by the company themselves.
Yeah, and also geopolitical tensions, I guess, playing into that as well, which can throw a spanner into best laid plans.
Yeah, just as a reminder to that, though, remember that the import agent for A2 product directly into China is China State Farms, which is an SOE. So that is often overlooked and really important.
Well, thanks, Stu. I'm conscious now that we're probably at 5 or 6 minutes past the time that we promised to release people. So apologies for the overrun, everybody. Thanks very much for joining us. We hope you found that interesting. As always, feedback, questions, comments through to me or any of the team here at Nikko will be much appreciated. And we look forward to catching up with you all again next month. Take care. Bye-bye.